if we are looking at an economy that comes into 2025 on a little bit stronger note than what we and many others have been expecting, you should expect inflation to be a little bit stickier. And Powell said as much last week, and this, by the way, gave the market some shivers in stocks. He said, hey, we're going to be patient. There's no reason to rush this. We think the Fed rate cuts the sequence ultimately will be truncated, and we're looking for just 2 more cuts between now and the end of 2025. So yes, we are looking for some inflation. The trouble is that all of the market movements you mentioned, higher bond yields, stronger dollar, right, stronger stocks, those are all in the direction of the kind of economy I described a moment ago. And they're also in the same direction as many of those Trump policies that we just finished talking about. So it's very difficult to disentangle those. If we do get tariffs, we think and immigration restrictions, we think most of that risk, inflation risk, comes at the end of 25, not in the middle of 25 or at the beginning of the year. So we do see stocks able to run from here further, and that's going to take the term premium and bond yields higher as well.
Who knows, right, who's going to end up with the Treasury portfolio? Right now it's Mark Rowan and maybe former Fed Governor Kevin Warsh. But, whoever gets that portfolio is going to have a big job on their hands. And one of the things they're going to have to address is to somehow try and right the imbalance in what's known as the term premium. A lot of the issuance right now, Treasury issuance, is at the short end. They need to move it out over to the right on the long end, yes?
Yeah, that's right. Back in November of last year, Treasury Secretary Yellen made the decision to issue fewer coupon bonds and more T-bills. What that did was restrict the supply of Treasury notes and therefore pushes the prices higher and the yields lower. It also increases Treasury bills, which are closer to cash, easily traded and sold for cash. And that increased liquidity at a time it was also going to keep yields low. So that was a very fortuitous sort of a move for the Treasury to make, help the economy, help the markets. But we're going to come into an era now where deficits, even without any further expansion from the deficit from Trump and the Republicans, those deficits are going to be increasing quite a bit. So you're going to have to make more use of the maturity spectrum, and that's going to start increasing that term premium, or in other words, the premium that investors demand to hold a longer term note rather than a shorter one.
So, Paul, one part of your strategy is to reduce short-term FI, fixed income, which makes sense, right? If you believe that whoever takes over the Treasury portfolio is going to be able to move issuance to the right over to the longer end, right? If that's the case, are you also long duration?
We're actually a little bit long duration here, but there's a little wrinkle to that because the volatility in the fixed income market has been mostly on the longer end of the yield curve. The middle part of the yield curve hasn't been as volatile. What we suggest doing is pulling money out of money markets, taking certificates of deposit that mature, and moving first into those 3-year to 7-year maturities. Create something like a laddered approach where you take cash and put it first into those intermediate maturities. And then when you're sufficiently overweight there to your satisfaction, then you start taking your underweights in the longer end maturities and you start moving those back up to neutral, back up to strategic weightings. And you do this incrementally, take bites at it. So today the rates are sort of hovering around 4.4. Maybe you wait until they make their next move up to 4.5. Maybe after that 4.6. So take little bites on the way up, but focus mainly on that intermediate part of the curve, and that will help to minimize the capital loss as rates get volatile again.